In today's episode, we will talk about the gravity equation for trading. But what is it? Let's enjoy it. Mathematics is a general subject. In this way, sometimes in different research areas, the same mathematical equations emerge. In such cases, although there might be some fundamental differences in the definition of the variables, we can take advantage of the fact that the solutions of the equations under analysis are well known. As it is well known, gravity in the weak field regime is exactly the Newtonian gravity. As any high school student knows, in the weak field regime, the gravitational force between two bodies is proportional to the product of their masses divided by the square of the distance between the bodies. In the equation appearing on the screen, capital G is just the Newtonian constant, which is universal. But wait a minute, how can the Newtonian equation be related to trading? For understanding this question, let's analyze the facts. The green lines, which you observe on the figure, correspond to economic corridors. Evidently, the trading flow between close neighbors is larger than the trading flow between distant places. But the concept of distance has changed in time. Nowadays, for example, we have planes which make our distances shorter. We have also developed fast-speed trains able to travel as fast as 400 km per hour or even more in some cases. Then, in general, when we want to develop an economic corridor, we first construct a good transport infrastructure. A good example of this is the Belt and Road Initiative developed by China, which consists on the development of some strategic economic corridors by constructing large-scale train lines and connecting them with the maritime lines. When the infrastructure is developed, then the effective distance between trading places is effectively shorter. Then, of course, the concept of distance between two cities has changed over time.
The concept of distance has changed quantitatively, but not qualitatively. Then still there is a higher volume of trading between neighbor countries and cities.
Thanks, Erika. Indeed, the notion of distance between places has changed. But still, when we analyze the trading data, it comes out that the trading volume between places still decreases with the distance. A simple example can be observed in this map. The city with the blue star, which could be perfect in New York, for example, has naturally a larger trading volume with the city identified with the red dot than with respect to the city located in Asia and identified with the yellow square dot. But besides the distance, the GDP is also an important factor at the moment of selecting trade partners. Then a city with a larger GDP is more attractive for trading. It has been demonstrated that the trading volume between a pair of cities is proportional to the product of the GDPs between the trading partners. On the map, we can see two Asian cities. The yellow square city is labeled with the capital letter Y with subindex O, which corresponds to the GDP for the city where the products for trading are originated. And the red dot city is marked with the capital letter Y subindex D, which corresponds to the GDP for the city of destination for the products. The effective distance between the cities is defined as tau with the subindex OD. Then, at the moment of deriving the trading volume equation, we find that it looks like the Newtonian gravity equation, with the GDPs operating as the sources of trading or equivalently to the masses of the system. Note that the effective distance tau has a power dependence of a parameter sigma, which corresponds to the elasticity of the prices of the products. The elasticity measures how easy is a change in the demand, given a change on the prices of the trading products. Then, in summary, the total trading volume between cities can be quantified with the gravity model. It suggests that the total trading volume between partners is proportional to the product between the GDPs of the pair of places under analysis and inversely proportional to some power of the effective distance between the same places. Note that the effective distance measures how much will the price at the destination increase with respect to the original price at the place of origin or factory. Finally, it is important to remark that the Newtonian constant in the gravity model for trading is not a fixed quantity, but it is rather a parameter which changes for different trade partners. In general, it depends on the market potential of the place where the trading originates and on the prices at the destination of different products. If you liked this video, please give us a like, share the link, and subscribe to our channel. More videos are coming very soon. Continue with us.